Markets are now at all-time highs, although volatility in stocks is also at a high level. Navigating the choppy waters is key while trying to take advantage of opportunities available for undervalued stocks. Using the principles of value investing as well as dollar cost averaging and persistent investment of funds is the key to growing and accumulating wealth. In this video, I'll discuss 3 different dividend stocks that you can purchase in May 2021, which are still undervalued and present great opportunities for not only gaining profits, but collecting substantial dividends along the way. Get ready. You are now entering the Academy. As we approach the summer of 2021 and the markets are at all-time highs, savvy investors are wondering what stocks they can still invest in that are undervalued to make consistent gains and generate passive income in the long term. In general, dips in a healthy market should be taken advantage of as the market continues to trend upward through 2021. And even though interest rates are still lingering near multi-decade lows and still on a downward trajectory, not all dividend-paying stocks are reflecting this low-rate environment with similarly low yields. A few income-oriented equities continue to pay above-average dividends. Without further ado, here are the 3 stocks that are still undervalued on May 2021 and which provide great opportunities for not only long-term gains, but passive dividend income along the way. For the first stock, we have AT&T, ticker symbol T. Navigating through troubled waters, the company's cable television brand shed another 620,000 paying customers last quarter, and for the first time since 2005 didn't raise its dividend payment in the first quarter of the fiscal year. These headwinds, coupled with a long-term debt burden of $160 billion, has kept continual pressure on AT&T stock for several years now. But besides this, AT&T is still an incredible cash cow. Supported by its massive wireless business and healthy growth from its entertainment ventures, the company's first quarter operating profit of 86 cents per share is not only 2 cents better than a year ago, but more than enough to cover the current quarterly dividend payout of 52 cents per share. AT&T also generated a per-share earnings of $3.18 in 2020. That was down from 2019's total, but considering the circumstances, the company still managed to earn more than enough to cover its full-year dividend payments of $2.08 per share. And with a dividend yield of 6.9%, this makes AT&T a great investment buy for those looking for a high dividend payer with potential growth going into the future. The second stock is PPL Corporation, ticker symbol PPL. It's not the world's best known utility company, but what PPL lacks in size or name, it makes up for in cash payments. Its trailing yield of 5.7% is the strongest among all the major U.S. utility stocks. The current quarterly payment rate of 42 cents per share translates into an annualized payout growth of around 2%, which isn't thrilling, but at least keeps pace with the current rate of inflation. Perhaps more importantly, PPL hasn't failed to make a dividend payment for 301 consecutive quarters and has upped its annual payout every year since 2000. The company intends to divest its UK-based utility Western Power Distribution for net proceeds of $10.2 billion by the end of July and is planning to acquire Rhode Island Narragansett Electric Utility from National Grid for $3.8 billion by March of next year. The deals will clearly change the fiscal scale of PPL's operation. Western Power Distribution accounts for about half the company's business. PPL doesn't expect its quarterly dividend to change before the Narragansett deal is done. PPL says it's expecting a dividend coverage ratio of between 60% and 65% after these transactions are completed versus 2019's pre-COVID comparison of 67%, and plans to grow its dividend payout in step with the earnings growth that's still in the cards. Point being, either through income or on the balance sheet or a combination of both, investors will be getting their value. The final stock is the Williams Companies, ticker symbol WMB. Although investors typically treat stocks from the same industry like they're all in the same proverbial basket, that isn't always the case. For example, so-called pipeline companies may transport natural gas and crude oil from one place to another. Their bottom lines, however, aren't intrinsically linked to the price of oil and gas the way explorers and services bottom lines are. Pipeline companies are paid on a per barrel or per cubic foot basis, and the prices being charged for delivery of these commodities don't change much simply because the consumption of these commodities isn't steady. One only has to look at the Williams companies, one of the biggest and best natural pipeline companies, to see how this dynamic holds up. Despite last year's suppressed oil and gas prices, service revenue of a little more than $5.9 billion essentially matched 2019's total. In this vein, the U.S. Energy Information Administration reports that the country's consumption of natural gas only fell 2% last year and further predicts that usage will remain stable through 2022. This in turn suggests the need for Williams transportation services will remain stable regardless of changing gas prices. The recurring revenue business model is an ideal one for income-seeking investors. More than that though, Williams Company's share remained only priced at levels seen just before the pandemic took hold and well below its 2018 peak. This means newcomers are stepping in while the yield's quite strong. With a dividend yield of a whopping 7%, this makes the Williams Companies a no-brainer investment for the savvy investor. The video provided 3 stocks that are underappreciated as of May 2021 and can be added to any savvy investor's portfolio, providing not only capital gains opportunities, but also substantial dividend income along the way. AT&T, PPL Corporation, and the Williams Companies offer investors substantial passive dividend income with high dividend yields and at share prices that could grow over time, providing additional capital gains along the way. An investment today could provide shareholders with not only passive income, but the possibility for growth as the economy continues to grow. That's what makes them dividend stocks worth considering buying now. If you'd like to pick up some of these stocks now, make sure to use the Webull stock trading app, which provides a great vehicle to purchase stocks commission-free, thus providing a great way to create and grow a dividend income portfolio using the methods mentioned previously. And if you register now and make your first deposit, you'll receive 3 free stocks that can be worth up to $1,600. So make sure you take advantage of this offer now. Be sure to check out the links in the description to get started on creating your very own passive income producing asset and start your path toward financial independence. Thank you for watching this video. If you enjoyed this video, don't forget to smash the like button. It will really help out the YouTube algorithm in bringing you more passive income and wealth creation strategy videos. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.